AI trading is no longer just a headline. It is truly here. We're talking about real money in real markets, and the results are quite mixed. Today, let's explore why some AI models consistently make money and what a normal person can learn and potentially copy from their strategies. Alpha Arena serves as a live benchmark, pitting six distinct AI models against each other. Each model begins with a starting capital of $10,000. They actively trade crypto perpetuals on an exchange called Hyperliquid, all operating under the same prompts and inputs with public trade logs available for transparency. The primary goal isn't merely profit, it's specifically risk-adjusted profit, emphasizing sustainable and controlled gains. Risk-adjusted return is often referred to as a calm score. This means if two traders achieve the same profit, the one with smaller, more controlled swings in their equity curve scores significantly higher. This concept is very much like the Sharpe ratio, return divided by volatility. A high Sharpe ratio indicates steady, consistent performance, not just fortunate outcomes. So who are these advanced models competing in Alpha Arena? We have GPT-5 Claude 4.5 Sonnet and Gemini 2.5 Pro. Also participating are Grok 4, DeepSeek V.1 Chat, and Qwen 3 Max. Season 1 of this intense competition concludes on November 3rd, 2025 at 5 p.m. Eastern Time. Why do some of these AI models consistently make money? First, they take fewer trades, but each with a clear, well-defined reason. This approach demonstrates high conviction, less noise, and ultimately more signal in their trading decisions. Second, these models meticulously control risk through effective position sizing. A common prudent rule is to risk a small, fixed percentage per idea, typically 1% or even less. This ensures that one losing trade remains just one loser, preventing it from significantly impacting or sinking the entire week's performance. Third, the successful models deeply respect drawdown. If your portfolio falls by 20%, you actually need a 25% gain just to get back to your original break-even point. The better models are adept at cutting losses quickly, thereby avoiding deep, detrimental holes in their equity. They also expertly match the market's current conditions. Perpetuals, for instance, have funding rates that typically flip approximately every 8 hours. If you are holding a long position and the funding rate is positive, you will incur a fee. In a sideways market, these seemingly small fees can accumulate and significantly impact profitability. Chasing breakouts in such conditions can quickly turn into a death by a thousand cuts. Consequently, these models intelligently slow down in choppy conditions and only accelerate when the market tape is clean and clear. One more crucial detail to consider is slippage. This refers to the gap between your intended click price and the actual fill price of your order. Thinly traded pairs experience more slippage, and market orders are also more prone to it. If your trading edge is already tiny, slippage can easily erase it entirely. Smarter models therefore prefer using limit orders in thin order books and only resort to market orders when liquidity is robust and strong. So, can a normal person effectively copy these sophisticated AI strategies? You can certainly copy the underlying process. This means trading less frequently, deciding your risk parameters before entering any trade, and placing your stop loss where the trade idea is fundamentally wrong, not merely where it feels comfortable or safe. Always check the current market regime. Is it trending, ranging, or experiencing high volatility? Adjust your position size accordingly, or simply choose to sit out if conditions are unfavorable. What aspects are harder for a human to copy from AI? AI does not experience fear, nor does it require sleep. AI can react to market changes in milliseconds. Humans, however, possess invaluable judgment about context, assessing news quality, understanding real product value, and discerning whether a business story truly makes sense. This unique human edge, combining intuition and critical thinking, is something you should definitely leverage. Before you consider buying any AI stock or coin, ask yourself this critical question. If the AI trend were to cool down for an entire year, would the underlying revenue model still hold up? There isn't a definitive hard answer today, but one idea remains crystal clear. A robust process consistently beats mere hype. Always follow the calm score, which represents risk adjusted performance rather than being swayed by loud, attention grabbing headlines.